Art Hogan, Chief Market Strategist at National Securities. Art, always good to see you. This market has been on a tear really all year long, despite the pandemic. What do you see as the biggest risk to this rally at the moment?
Yeah, I think the market's been on two tears. And if you look at the March 23rd low to September 2nd, that was a rally off of the lows, really driven by a handful of technology stocks. Then we had a bit of a correction, call it 12% correction in the SP 500 in September. And this second leg has been a much healthier rotation into economically sensitive cyclicals. And I think there's a lot of legs to that. So in the here and now, we're in a tug of war between vaccine news and virus news, and the tiebreaker in that has been the potential for getting more stimulus out of Washington. And whether that happens today or Monday, we believe it's going to be one of those 2 days that we actually get the stimulus package out. Then we're going to run out of positives, right? And we're going to start to focus on negatives. So I think that over the course of next week and into the end of the year, we'll start focusing on that negative virus news, the restrictions that are going to follow in the path of what's increasingly becoming a dreadful virus with case counts rising and hospitalizations rising, et cetera. Then we get into next year, I think we can start to focus on the fact that we're getting closer and closer to when you and I will actually be vaccinated and things will start to return to normal. So it's really been a tale of two markets this year. It's that mega cap technology rally that lasted from March till September. And now it's the Russell 2000, the economically sensitive energy, financial, industrial materials that have actually outperformed from September into coming into this week.
Yeah, those small caps have really done right by investors who have stuck with them. But having said all that, Art, what's your approach to the equity portion of the portfolio come early next year?
That's such a great question, Alexis. So what we'd really like you to have is a barbell approach. So let's say you and I have a 60-40 portfolio, that's 60% being equities. We'd really love you to have a barbell approach where you continue to have growth on one side of that, because we believe growth has a place in every portfolio. And on the other side of that, we'd like to have economically sensitive cyclical. So we'd like you to express that growth in things like technology and healthcare. And on the economically sensitive cyclical side, we'd love to have you have exposure to financials, industrials, and materials. And if you were to actually have that portfolio in 2020, rebalanced every 2 months, you have outpaced the S&P 500 by nearly 500 basis points. And we think that same kind of balance, that diversification going into 2021 is going to have the same kind of impact. So think about that diversification. It's not always going to be just small caps and cyclicals. It's not always going to be just technology. But if you're always rebalancing and keeping those proportions intact, I think you're going to outperform next year very much like you would have this year.
All right, so then what are you avoiding next year? Any particular sectors we should know about?
Yeah, it's such a good question too. And one of the problems in this low interest rate environment is that hunt for yield. And what that has caused is some very high valuations in what are typically very defensive groups. So for example, if you look at the consumer staples, they've really exploded this year. So we get historic high multiples, some of the staples trading at 25 and 26 times with dividends that are at historic lows. We would avoid that. And if you're looking for a bond surrogate or a yield play, we'd rather have you look at REITs, especially industrial and healthcare REITs. Avoid any of the lodging REITs and the retail REITs, and BDCs and business development companies. And either one of those, you can play that in the equity side or in the baby bond side. And I think that's a much safer place to be finding your yield next year than perhaps staples and some of the telecoms and utilities, for example, because all of those multiples have gotten very high and the yields have gotten very low. We'd rather have you seek out that yield in REITs and BDCs.
Do you hold any Tesla, Art, right now?
No, I don't. I, yeah, I wish that I did, but I've just never been able to get my arms wrapped around what kind of a company this is. Dan Ives does a great job. I know he's going to be on the show later. It's an amazing story, right? But it's a story, right? It's not that if you were to say, let's put, how much is this valuation market cap per car that they sold this year? And it's like $1 million, right? It's $1 million per car they've sold this year. So at some point in time, this dream is going to come true. But when we think about the EV portion of the overall motor vehicle right now, it's still below 5%, right? So this is a hope and a promise for the future. They've obviously, gotten a huge jump on this. General Motors is going to try to catch up, and there's a lot of exciting EV companies that are coming public this year. But it's been something we've just kept most of our investors away from, especially the sort of widows and orphans and the not faint of heart. But it's an amazing story, and we'll see what happens today. This is the largest company to ever be put into the S&P 500. Which means that you have to sell the other 499, which is going to put an amazing amount of pressure on that closing print. both purchasing Tesla and selling the rest of those names. And I think we're going to see a whole lot of volatility this afternoon.